take this conversation forward. We're now being joined by Samiran Chakraborty, the Chief Economist at Citi India. Samiran, good morning. Thank you for joining in. Season's greetings to you first up, to you, your family and your team as well. And as you heard Ritu summarize the road ahead for the Indian economy, what are your house calls at Citi when it comes to the GDP growth for the year? And more importantly, with inflation remaining as benign as it remains, do you see further case for an easing stance from the Reserve Bank of India to continue as well?
Thank you. Good morning and season's greetings to you as well. So first on the growth side, I think all of us, we understand that the extent of fiscal and monetary stimulus that supported growth in FY26, the same kind of stimulus might not be available another year in FY27. So obviously it's possible that the FY27 growth numbers are a tad weaker than what was reported in FY26. But I think compared to the poll that you just presented, our numbers are slightly on the higher side. We think FY26 would still be an above 7% real GDP and a marginally above 10% nominal GDP growth. That's because we think the global headwinds also will be much lesser for India this year. In general, global growth has sustained much better than feared. And if we get our tariff deal in the early part of the year, then that could also be a positive from a global perspective. So altogether, it's possible to get a 7% real GDP and a 10% nominal GDP type of numbers for FY27. On inflation, we are slightly lower than the poll. We are at 3.8 average for the full year. That means from a growth inflation standpoint, there is space for RBI to ease marginally more. The question is the timing about it. Would RBI wait for the new GDP and CPI data series to be released to get confirmation that even in the new series growth and inflation is like this? And to what extent this whole dynamics about the external sector and the currency will play a role in further rate cuts? I think that's something that we have to see. But a small space for monetary policy easing is there.
Okay, Mr. Chakraborty, hi. This is Ritu stepping in, and season's greetings to you. But while you're talking about 7% plus real GDP, 10% nominal growth rates, and even in the past year with the kind of GDP numbers we've seen, what has really played out is this detachment between what's happening on the macro front and the markets underperforming. Why do you think the markets are not really believing this broader macro improvement story? And secondly, on the rupee as well, the balance of payment numbers, the economists are very, very split. The average is about $7.5 billion of inflows. How do you expect the rupee to move? And, will it more be linked to BOP than, typically what we see with interest rate differentials? And what is the best and worst case scenario?
Why this disconnect between markets and macros? I think there are three things that is pushing the GDP growth numbers higher, but at the same time is not getting reflected in the company performance. The first is that in India's consumption story now, services has now a disproportionately higher share in last 3 years. 60 to 80% of incremental consumption is coming out of services. And clearly in the market space, the proportion of services companies are relatively lower compared to the goods companies, and that's where the disconnect is there. The second is that in this cycle, the rural is doing better than urban. Again, the same argument applies that the rural representation in the market is relatively lower compared to urban. So that's creating a gap. And third is this whole listed versus unlisted companies. Our sense is that the unlisted companies' growth is much better. And that's why this is pushing up the overall GDP growth numbers with a somewhat disconnect between what the market is thinking about growth is. There is a fourth one which people are talking about the nominal versus the real. I think that problem is a temporary problem. If your forecast is correct and next year nominal GDP growth picks up about 10%, then automatically that will pull up the nominal earnings numbers as well. On rupee, it's more complex. It's more complex because We are expecting that next year we will get into positive BOP situation. In fact, our forecast is that even in the Jan-March quarter, the BOP should turn into surplus. If not for anything else, seasonally, the current account is much better in this quarter. Even for next year, our forecast compared to your poll is much better on the current account. We are expecting only a current account deficit of 0.5% of GDP. So that gives us some confidence that next year, the currency dynamics will be determined more by the traditional driver of the currency, which is inflation differential. This is a year, FY26, where the inflation differential did not play a big role. Our inflation was much lower, but still our currency depreciated. I think next year this pattern would change. And that's why we think that RBI should be able to keep the currency broadly around that 91 kind of number rather than the 92 that your poll is probably forecasting. So that's where we are slightly non-consensus in thinking that there's a possibility that the rupee underperformance of 2025 might not repeat in 2026.
Okay, but Mr. Chakraborty, rupee aside, you earlier mentioned the policy space that is available. I mean, how real is this sort of policy exhaustion risk? The RBI, as per most in the market, is nearing the end of the easing cycle. How long can it stay accommodative? And even on the fiscal front, the government has already taken the hit in terms of lowering the GST rates. How much more can it really do to prop up growth without really hurting its finances?
First, on monetary policy side, I think the focus should not be on how much more rate cuts can be there. I mean, that's probably a smaller number. The bigger focus should be on how long RBI can elongate this easy rate situation through guidance, through liquidity. I think that's going to be the main story for 2026. We've already seen that RBI has been very proactive with its OMO announcements in December. Despite that, bond yields have not come off as much. So one could easily imagine that where bond yields could have been if those OMOs were not announced. So that's where the fiscal thing comes in, that while it's true that in late phase of the rate cutting cycle, the term premium goes up, the long end bond yields go up. But in this cycle, particularly, I think the fear that fiscal will be a challenge. The supply will be a challenge. Even we are forecasting that for FY27, the gross supply of bonds, state plus center, could cross 30 trillion rupees. So that's a very big number for the markets to digest. That's where RBI will have to be cognizant that any further rate cut could affect the bank deposit growth and in turn could affect the demand for bonds as well. So it's a very relatively more complicated late cycle fiscal and monetary policy management that the RBI will have to do in 2026.
Yeah. Mr. Chakraborty, just to close in one line, what will matter most for India in 2026 from a macro point of view? Is it, what will really enable that Goldilocks scenario to continue? I mean, is it sort of strong macro fundamentals or a return of the capital flows? What will be the big focus area for you?
I think return of capital flows. I think it's important that India gets back into a BOP surplus situation. In India's post-liberalization history after 1991, we have never had 2 consecutive years of BOP deficit, which we are going to have in FY25 and FY26. So in FY27, that BOP needs to turn into surplus, and that will solve a lot of our niggling issues, is what our sense is. So I'll be very much focused on that number in the short term.
All right, Mr. Chakraborty, many thanks again for giving us your time, and it was a pleasure speaking with you.